Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show, we welcome Juliette Declercq, who's the founder of JDI Research. Welcome to the show, Juliette.
Hi, thank you very much for inviting me.
Let's begin by talking about your background and how you began your career within the markets, Juliette. Was there a specific moment which really made you think of becoming a trader and to be involved within the markets? Was something that you wanted to pursue? Talk to us about your journey so far.
So my journey was really an accident. I wanted to be a doctor, but in the late 90s, anyone who could count quite well was basically pushed towards finance. We were basically bang in the middle of the debt super cycle, and it was really the go-to industry. So really, how did I end up in the financial industry? Well, I'll say I had big dreams and a strong need and desire to achieve these dreams. So the dilemma was between studying for 10 years or study for half this time, and also you could just basically start part-time jobs straight away. So I think the desire for financial independence is really what won it over for me. So I worked during my studies in a bank, which was a springboard to land a job in finance in London, and that used to be the old El Dorado.
I know a lot of your research is macro-focused, so let's go over some of the big themes within the economy and markets that have perhaps surprised you this year. And as we start to head towards the end of 2019, does the environment for negative yielding bonds and interest rate cuts appear to only continue going forward? What's your outlook on this?
So firstly, the one big theme that really surprised me this year is our populism, which is supposed to be a political approach that strives to appeal to ordinary people, actually became just so self-destructing and basically leads to like a die-hard necessity for aggressivity. So the Trump and Johnson of this world run the economy and the global economy to the ground in the name of quote-unquote ordinary people, yet they're both hoping to be re-elected for one and elected for the other. Unfortunately, I think that's the monster that financial repression has created. If central banks can prevent market crises through ultra-loose financial conditions, then the ordinary people do not see the direct consequences of the ongoing political and geopolitical nonsense. So perhaps we need the ongoing slowdown to really start costing jobs for populism to be about the people once again. So that's more like on the geopolitical side. On the pure macro side, one thing that really surprised me this year actually wasn't negative. It was really the resilience of the consumer. And I'm talking not only about the resilience of the consumer in the US, and quite frankly, I've been really flabbergasted by like the reaction to, basically markets pricing like 2 hikes last year to basically now markets pricing, more than like 4 cuts this year, and straight away the US consumer responded. And I think that's really interesting to see, like, in the world, a consumer that still basically reacts in the right behavioral way to lower interest rates. On the other side of the equation, I think what was really surprising, well, not really surprising for me, but was to central banks, was the fact that lower rates in the rest of the world, and I'm talking Japan and Europe, is really having the opposite behavioral consequence, meaning now, you see rates going further negative and you actually start saving more rather than spending. So I think that's really the one thing that's a bit of a, that was like, one thing wasn't a surprise for me. The other one was a surprise for me. What I do think is that it's not taking us to more interest rate cuts in Europe and Japan, because it's basically working in reverse, e.g. lower rates equals more savings. So I think we're going to have like a discrepancy between monetary policy is still being used and potentially abused in the U.S., but in Europe and Japan, we're going to go fiscal, and it might not be next month, but that's something that we're going to be talking about a lot more. And for markets, markets don't need to be driven by news; they need to be driven by what's the next thing, and you don't need to see reality before pricing it.
Let's move on and talk about gold. How do you view the recent move in gold over the last few months? From a big picture perspective, is the gold market perhaps signaling to investors that the time for real assets is now here? Is gold now perhaps beginning to move in a way that suggests that the current monetary system is not sustainable? What's your view on gold?
Look, I see the case for higher gold, and that's actually something I've recommended to JDI research customers until August this year, and that was on the anticipation of global yields collapsing. But what I don't think is that much deeper real yields will be the monetary answer to the next downturn. In fact, I think the answer will be cooperation between monetary and fiscal authorities, getting the money to the people rather than through the financial markets. And what I also think is that it will actually work, because if you put money directly into the right pockets, you actually get it spent. So that's a form of monetization, or, MMT, if you prefer. The difference between monetization and MMT in my book is that with monetization, you still have the central bank's independence, and then the central banks keeping, being like the guard of inflation. And the thing is that it will put a bottom in yields, but we will still be somewhere to outright inflation, and with central banks fully in control of the money created. So on one hand, gold does not benefit from inflation fears, and on the other hand, I don't think the global monetary path is generally going to be negative yields and deeper negative yields, because, as I just said, it's actually contractionary. So the bottom line is that I'm not a gold bug. I think there will be time to own gold tactically, and this year was one of those.
It'll be interesting to go over a few of your key successes within the markets, and perhaps a few of your mistakes as well, and also understand why they occurred and what you learned from them. Can you share that with us, Juliette?
Yeah. I get things wrong all the time, but actually that's what makes experience. In fact, I'll go as far as saying that being wrong is a complete part of my process, and it should be part of any trader's process, because it's not really about being wrong so much, but about being wrong in a small size, basically a size small enough that when you realize why you are wrong, basically through hard work, you can actually become right in a much bigger size and with much higher conviction. So I think really being wrong is actually often, in my case, it's actually been often the start of being really right and the best run on the market.
Talk to us about a few of the books or authors that have been key to how you view the markets. Which books have been the most important to you throughout your career so far?
So that would be a book that my boss gave me at JP Morgan. I think it was a bit of a thing to celebrate, the first million you make for the bank. And it's reminiscent of The Stock Operator by Edwin Lefebvre. What really it made me realize is that for every, and it might be something that sounds quite silly, but is that for every buyer in the market, there will be a seller who potentially has the exact same information that you have, but thinks about it differently. So in the end, market prices are all about the quote-unquote tape and how weak or strong buyers are versus sellers. So I think what I really want to say is that it's not about the news, and what I learned through that book is absolutely crucial to the rest of my career, which is basically that the key to strategy process is that you never want to be the one forced to trade on news. You want to preempt the news and always be in a position of strength. And for this to happen, you basically need to understand the underlying macro and market trends and basically completely ignore the news.
Excellent. Okay, as we begin to wrap up, is there anything else you'd like to talk to us about today? Any markets that you're keeping a close eye on now?
There's one thing that, because I know you're a commodity channel, there's one thing that I always keep an eye on, and even if I don't actually often recommend positioning on it, is copper prices. So if you look at what happened last year, 2018, so I always look at copper or copper gold ratio in relation to what bond prices are doing and bond yields. And it's always, and copper does tend to lead not only the bond market, but also on equity markets, sometimes by up to 6 to 9 months. So if you actually look at what happened in 2018, is we had bond yields shooting up and equities doing quite well until last few months of the year. But copper actually totally saw through this and was actually already on a downtrend from much earlier in the year. So I really like to, so at the moment I'm trying to take a bit more of a glass half full view on the world, and I see a way things could be evolving more favorably, or at least much more favorably than what consensus is thinking at the moment. But if I see copper really start to make new lows, that would really be something that I'll be getting more cautious about.
Okay, fantastic. Well, thank you very much for your time today, Juliette. It's been a pleasure having you on the show today.
You're very welcome, and thank you for inviting me again.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
Yeah,